fall in liabilities after the Lehman collapse, you can see a big recovery afterwards. The big recovery has caused the net international investment position of India to deteriorate, but that in itself is not a big deal because this is a recovery in equity liabilities. If, as is happening now, the economy slows, less dividends are paid out, no crisis. So this is a stabilizing factor. India's balance sheet, in fact, is quite interesting if you break it down into its components. On the asset side, we have very big foreign exchange reserves, some debt assets, some FDI assets. So here's a asset portfolio that is very liquid, which in a crisis is a good thing. On the liability side, there is certainly some debt, and corporates who have borrowed in dollars are now experiencing some pain due to that debt. There are FDI liabilities and a lot of portfolio equity liabilities, but most of what we see here is equity. And the portfolio liabilities fell sharply in the crisis. Then they came back. Now they're falling again. But again, that in itself is not a cause for turmoil in markets the way that debt causes turmoil in financial markets. The US position is actually the opposite of this sort of position. The US holds assets that are very skewed toward equity. It holds assets that are concentrated in debt, much of it short-term banking debt. And the result of this is that essentially the US is issuing liquidity to the world. It is holding equity. India is in the reverse position. This leaves the US somewhat vulnerable in crisis situations, which is why the US lost so much on its net assets in 2008. I don't want to argue that current accounts do not matter, that we should worry only about the gross assets and liabilities. And there are basically two arguments that are put forward for the proposition that current accounts don't matter. One argument is based on the idea of very efficient markets. The other is based on the opposite of very inefficient markets. The inefficient markets view is one that I've basically just given you. Financial markets are arenas in which people and institutions are going to make unwise bets. These give rise to very large gross asset and liability flows. These are governed in many cases by tax arbitrage or regulatory arbitrage, and those are what we should worry about. The net current account is much smaller than those and is not a big deal. The efficient markets view comes in different flavors. One is that asset markets are complete and perfect, which is a view I don't agree with and which I think recent experience discredits. The Lawson doctrine, which is that if you are running a balanced government budget, the current account doesn't matter because it's the outcome of optimizing decisions. And there's a variant of this which is very popular in Australia, which has run significant current account deficits for many years with limited problems, is known as the consenting adults theory. Transactions between consenting adults are mutually beneficial and shouldn't be interfered with. If they end up giving you a current account deficit, so be it. And the Australians will argue this very, very energetically. Some other observers, such as the IMF, don't really agree. The inefficient markets view has some evidence to back it. For example, we saw surplus countries such as Japan, Germany, Switzerland, the Netherlands get into trouble at various points. Japan after its bubble, Germany and Switzerland, the Netherlands, and the recent financial crisis. If you can run a surplus and still get into trouble, why should we worry about the current account? Shouldn't we just worry about the bad investments that these surplus countries may be making, investments which they may be making in deficit countries? clearly the gross positions are critical. And as I said, even surplus countries may make bad investments abroad. And if leveraged institutions are the investors, then troubles are going to follow. And so information on gross flows and positions is really critical for safeguarding financial stability. A very nice example of how these gross flows get generated is in a paper in the IMF Economic Review by Viral Acharya and Philip Hon'ble. And they describe the activities of European banks prior to the 07-09 crisis. These banks set up off-balance sheet conduits to invest in asset-backed US securities, which later became toxic. The great motivation they had to do this is that these asset-backed conduits did not carry high regulatory capital requirements. So basically this was a form of regulatory arbitrage. The banks borrowed primarily from US money market funds, and they recycled the money into US asset-backed securities. So on both the US side and the European side, you saw gross assets increase, gross liabilities increase at the same time. So this is very much like the data that I showed you. The motivation was to escape regulation, to escape the holding of adequate regulatory capital. And it was thought that these AAA-rated asset-backed securities were completely riskless. That ended up not being the case, and the result was financial fragility and a dollar shortage when these same banks found it impossible to roll over their short-term dollar funding after the money market funds and other lenders pulled back. So, we have very good examples of how this process has worked, very good case studies to show us that we really do need to worry about these gross flows. Yet, the G20 and the European Commission even care about these current accounts. The European Commission has decided in light of the euro crisis that going forward, intra-Eurozone current accounts should be monitored. Whereas a couple of years ago, it was an article of faith that in a currency union, you don't worry about the current account. There were data on the current account, but within Europe, people really didn't want to look at it. In the US, we don't have data on states' current accounts, and we don't worry about it. But the European situation was different, and the European situation was different because of the absence of a supranational fiscal authority with the power and the responsibility to ensure financial stability. Therefore, in Europe, we saw very large current account deficits, those of Spain and Greece, leading up to the crisis, but nobody worried about them until it was too late. The point that teaches us is that in many cases, the current account is a symptom of underlying financial problems. This was true in the US in the 2000s. There was debate over whether the current account was a sign of the great value of investing in the US or a problem somehow related to low saving by households. And clearly it was a symptom of a problem. But there are other reasons to be worried. Again, consumption possibilities will be compressed. There can be sudden stops in lending. There has to be adjustment in that case. The current account may measure the extent of adjustment, but if there are short-term liabilities which have to be rolled over and which the markets won't roll over, this also becomes an additional burden. The whole discussion that continues about global imbalances shows the effect of large changes in current account positions on world interest rates, which have externalities for other countries. Large surpluses are worrisome because they threaten protectionist pressures, as is currently the case with China. So, in my view, there are still many reasons to worry about current accounts. The econometric evidence on whether current account deficits actually predict crises is somewhat mixed, surprisingly so in light of some of the examples we have of countries like Mexico, Thailand, Finland, which ran large deficits and also suffered crises. But there is stronger evidence that credit